Welcome back to the channel. In this video we're going to explore the Dividend Kings. There's 29 Dividend Kings in total. I'm going to pinpoint 5 that I'm interested in and narrow the list down to 1 that I'm very interested in. Stick around for more. Thanks for watching. I'd really appreciate it if you could hit the subscribe button and click the notification bell so that you always find out when a new video is posted. Okay, so let's dive straight into what are Dividend Kings and why invest in Dividend Kings. Dividend Kings are companies who have increased their dividend payout for at least 50 consecutive years. In addition to the long track record of increasing its dividend, a Dividend King must have a market cap of at least $3 billion, so it has a level of size. Also, why invest? First and foremost, Dividend Kings are dividend stocks, and while dividend stocks can play a role in any investor's portfolio, it's important to understand that stocks of Dividend Kings put value above growth. Dividend Kings have historically higher overall returns over extended periods, so they're great for long-term investment. But how do you know a Dividend King's dividend is stable? To do that, you should pay attention to the dividend payout ratio. The dividend payout ratio is simply the amount of a company's earnings that they apply to its dividend. Some sectors, like utilities, are known to pay a high percentage of their earnings as a dividend, but in general, you will want to make sure that whatever you pay out, whatever the company pays out, is sustainable. Among current Dividend Kings, the lowest dividend payout ratio is 28% and the highest is 80%, with the average being 54%. As we'll see later, I like to apply a filter of 75% when assessing the sustainability of dividend payout ratio. How are Dividend Kings different from dividend aristocrats? The only difference between the two is in the number of years of dividend growth. Dividend aristocrats have the distinction of increasing dividends for over 25 years. The easy way to think about the two groups is that every Dividend King is a dividend aristocrat, but not every dividend aristocrat has risen to the level of Dividend King. Either way, these companies are regarded as the most sought after stocks for income orientated investors. So let's now take a look at the current list of Dividend Kings and how I apply criteria to decide whether I'm going to invest in these companies. So here we have the list of 29 Dividend Kings, which I've downloaded from the Market Beat website. So you can see in column A we've got the 29 Dividend Kings, some really well-known names: Colgate, Palmolive, Johnson & Johnson, 3M, Lowe's companies, Coca-Cola, Altria Group, some really well-known names. But I would never consider myself investing in all 29 just because these companies are regarded as Dividend Kings who have increased their dividend for the last 50 years. Doesn't mean that they're going to do it for the next 50. You always hear the phrase past performance is not a predictor of future performance, and that holds true here with these Dividend Kings. So what I want to do with these is set some criteria to reduce this list from 29 to a more manageable group of companies. Not just manageable, but also attractive. So what I've done, I've got dividend yield in column B, payout amount and payout ratio in column D. So I'm setting some criteria that I'll explain now. So dividend yield, I'm going to only look at companies with a dividend yield of between 3 and 8%. Okay, 3% makes it attractive, over 8% and I'm really questioning sustainability. Likewise for payout ratio, as I mentioned earlier, I really want the payout ratio below 75%. When a company pays out more than 75%, you have to question the sustainability of that dividend. Now, by their very nature, Dividend Kings should have a good ratio here, otherwise they wouldn't have been able to perform a dividend payment for this length of time. But anyway, I think it's important. Companies may be starting to struggle, maybe overstretched, so we want to get rid of those companies that are looking overstretched. So let's just filter now on dividend yield between 3 and 8%. That reduces the list from 29 to 7. And then let's get rid of any companies with a payout ratio above 75%. And that reduces the list to 5. So we have a much more manageable list of companies now. So we have Cincinnati Financial, Emerson Electric, Federal Realty Investment Trust, Genuine Parts, and 3M. Okay, so now what I've done is I've got some extra information here. So 3-year dividend growth, you can see all companies have been growing the dividend. P ratio. Now the only one that I'm concerned about here is Genuine Parts. I'm not going to set criteria here, but I am going to note quite clearly that Genuine Parts is operating at a negative P ratio, which concerns me. Where I am going to put a filter is BTM rank. BTM rank is the beat the market rank, which looks at a range of criteria and gives a score out of 5. What I want here is a score above 2. Now quite clearly you can see there's only one company scoring above 2, and that's Federal Realty Investment Trust. We'll then look at price, so share stock price. I'm looking at the current price. Now bear in mind this information might be a little bit out of date, but I'm also looking at price targets taken from analysts' consensus, and that's again taken from the Beat the Market website. So what I'm doing here is looking for companies with 5% price upside or more. You can see Cincinnati Financial doesn't qualify. Emerson's just below the 5%, so we might still consider Emerson, given that it's also got a beat the market rank quite close to 2. But we can clearly see Federal Realty Investment Trust and 3M are best performing, with Genuine Parts trailing behind at 2%. So to me the interesting companies here are Federal and 3M. Perhaps Emerson makes it just. We then come on to the strength of the balance sheet, and to do that we take a quick look at the quick ratio, which is a very simple measure of assets and liabilities. I want the ratio above 1, which simply means that the company can cover its short-term liabilities. I can see again Emerson's just shy of 1, so we might keep them in there. Federal looks very strong, almost 5. 3M looks good. Genuine Parts looks a little bit weak. Cincinnati Financial would be definitely out of the running here. Book value is a look at the share book value for the company, so it's interesting to look at this compared to current price. So you can see that Cincinnati Financial's current price is 1.27 greater than the book value. You really want something below 3 here to suggest that the stock is potentially undervalued. So the only stocks that make the grade here are Cincinnati and Federal. 3M looks to be an issue. Finally, we look at profitability, and I want to see net margins above 10%. Margins below 10% would make me wonder about the ability of the company to drive a profit. We can see all companies are performing pretty well here except Genuine Parts. Return on equity, we can compare that to the market. Cincinnati Financial would probably be the only company that looks a little weak here. But all in all, I would be looking to invest on the basis of this analysis. Emerson potentially makes the grade. 3M potentially makes the grade. Actually, as a disclaimer, I'm already an investor in 3M. But the stock that really stands out to me is Federal Realty Investment Trust, which looks strong. Looks strong in terms of its position as a dividend king. It looks strong as its position on the BTM rank. There looks to be some price upside, some very healthy price upside, so you could be looking at growth in the value of your investment, not just the dividend return. Balance sheet looks strong. It's potentially undervalued, and the net margins are extremely strong. So Federal Realty Investment Trust is the dividend king that I'm interested in. I'm also going to look more closely at 3M and potentially Emerson Electric. So I hope that's been useful. If you've got any questions, please leave them down below, and I'll look forward to seeing you again in the next video.